Assalamu alaikum and good morning class. In this lecture, we will be discussing receivable management. So our objective for the receivable management is to manage the receivables because we encourage sales and we wanted to gain additional customers by extending credit. So to evaluate the pertinent costs and benefits related to credit extension, we wanted to manage and um, finance our firm's investment in accounts receivable by implementing the firm's credit policy and through enforcing collection. So here are the costs associated with accounts receivable. So for mnemonic device, let's just use the code C2D2. Okay, so C stands for credit analysis, accounting, and collection costs. So before we extend credit, we need to constantly monitor by analyzing our credit. So we wanted to do aging of accounts receivable and the likes. Second, capital cost. What are the investments in accounts receivable? Okay, because if we wanted uh, to make our money more profitable, we need to manage this because the amount or the funds or the investments that are tied in the accounts receivable does not earn interest. Okay, so these are just the money tied in the hands of our customers, and if we could have put those money somewhere that earns higher return, then that would become our opportunity cost. So that's why we need to constantly monitor how much is our capital costs. Third, we have the discount cost. Okay, so discount cost, because we are the seller, so we are giving discounts, we are extending discounts for prompt payment, no, to motivate our customers to pay earlier so that we can have the cash conversion also earlier. And we have the last, the default cost or the delinquency cost. So these are the costs due to non-collection of accounts. So these are our bad debts cost. Okay, so since the firm's credit policy is the primary determinant of accounts receivable, um, our credit policy is a key determinant of sales. So that's why sales and marketing executives are concerned with this policy. So what is credit policy? So credit policy is a set of rules that include the firm's credit period, discounts, credit standards, and collection procedures offered. Okay, so this consists of four variables. So we have first the credit period. So we all know, it's quite understandable. Credit period is the credit period, the length of time customers have to pay for purchases. So usually we encounter N30 and 45. So it means our customers need to pay within 30 days. So if, of course, customers prefer longer credit periods. So lengthening or extending the period will, of course, stimulate our sales. But, there's a but, a longer credit period lengthens the cash conversion cycle. So, as what we already discussed in the cash management, our objective in cash management is how to shorten our cash conversion cycle. So, why? Because it ties up more capital in our receivables, and that is very costly, no, on our part. So also, the longer our receivable is outstanding, the higher the probability that the customer will default. Of course, so if it's human nature, customer will tend to um, forget their accounts payable. that's kind of the Filipino mentality, no? Ano ba, malimutan yung utang, no? Patagalin para hindi na mabayaran yung utang, no? So, of course, we need to balance that our credit period will not be too long because we just increase the probability that our customers will be defaulting, so it will end up as a bad debt. Okay? So, second, we have the discounts. So, of course, discounts are price reductions given for early payments. So, say for example, 2% discount. So, 2% discount if given if a customer pays within 10 days. So, this discounts actually has two benefits, right? So, first, the discount amounts to a price reduction. So, of course, if we reduce our price, it will stimulate our sales because more customers will buy because of the reduced price. Second, discounts encourage customers to pay earlier than they otherwise would. So, meaning that would shorten our cash conversion cycle. However, no, discounts, since we are the seller, it means lower prices. And lower prices means lower revenues unless the quantity sold increases by enough to offset our price reduction. So, these benefits and costs of discounts must be balanced. Okay. So, for the third variable, we have the credit standards. Credit standards refers to the financial strength customers must exhibit to qualify for credit. So with regard to credit standards, factors considered for business customers would include ratios, no, like customers' debt, interest coverage ratios, okay? So credit history, if we are talking about institutional customers or yung business customers, now we look at their solvency and liquidity ratios. So for individual customers, we will look at the credit score. Okay, so of course, before we extend credit to someone, we need to assess a background check whether that person is paying debts or whatever. So if there's already a history, a record, so usually that's already an X, no? If there's a history of non-payment or deliberately forgetting the account, so that's an X factor. Okay, so of course, if our credit standards is too high, okay, so we may not have, we may not attract customers, right? Because it's too tough, no? So we will lose sales and we will lose profits. But if we set our standards too low, of course, bad debts, our losses would be too high also. So a balance must be maintained, no, between the cost and the benefits of credit standards. Okay, so of course, we need to set standards, no, because of course of us on the individual level, if you do not have standards, then anything or anyone can just penetrate you, no? Okay, so you need to have standards on how to choose friends and how to choose companions and how to choose yun, acquaintances, no? So you have to set those standards if this person is like this and like that. So of course you do not want bad influence, so you need to limit as least as possible, okay? But if that person, if let's say a good influence, so you need to spend more time with them, no? So it's just like business standards, because without those standards we will fail, of course. Okay, so fourth, we have the collection policy. No, so collection policy, this is the degree of toughness in enforcing the credit terms. So of course, time and time again, we need to set a balance between the costs and benefits of different collection policies. Not to tight naman that if the customer will just miss one day, you will constantly nag and nag until you knock on the door to just collect payment, and not to relax to the extent that it's months and years. No, of course, if that is the case, then consider the debt a bad debt. Okay, so that's why tinatawag siyang bad debt kasi masamang utang, no? So, we are talking here about receivable management. I am not, again, just a disclaimer, I am not enforcing you, no, to have credit, no? Because I personally believe that we should avoid credit as much as possible. Both applying credit and giving credit. No? So, well, anyway, that is for our personal and spiritual standard also. No? Okay, so next we have a self-check question. So this is self-check question number 1. So we have here our credit scoring system. So it was mentioned that for individual customers, we are going back to the popular 5 C's of credit. So 5 C's of credit, so we have character. So of course, character matters, okay? So that's why, right, even in businesses, they are strict with character because we as a person, on the personal level, we need to be choosy, no? Because if you are not choosy, then all external factors can easily persuade you, no? So sayang, no? So that's why you need to have standards, especially on the character. So if the character is good, then extend more credit, like encourage the customer to take credit. But if the character is bad, if possible, you will just eliminate that person, no? Okay, so eliminate that customer because it will not do good in your business. So second, we have the capacity. So capacity is very important because this is the ability to pay. So of course, if the customer lacks capacity to pay, so of course you should not extend credit, or extend credit only up to the extent of his or her capacity. So if the capacity is, let's say, the net worth of the customer is just, let's say, 100,000, then do not extend, just extend siguro 10% of that, no? Or lesser, or even 5% of that, because that person has no capacity to pay higher amounts, no? So you have the tendency of running into bad debts. Third C, we have the capital. Okay, so what is the capital? So how much is the worth of our receivable investment that will be tied to that customer? Letter D, we have collateral. Okay, so collateral, it means something to guarantee our credit. So in most credit situations, this comes in the form of mortgage. Okay, and last, we have the conditions. So of course, terms and conditions are very important. Okay, because without those conditions, without those agreements, everything is doomed to fail. So that's why may klaro na usapan dapat. Okay, so how many days to pay, what are the penalties of default and whatever, and the legal consequences of non-payment. Okay, so the total amount of our accounts receivable outstanding at any given time is determined by the volume of our credit sales and the average length of time between sales and collections. Okay, so let's have an example here. Suppose a company has sales of 1,000 per day and that are all on credit, and it requires payment after 10 days. It has no bad debts or slow paying customers. Under those conditions, it must have the capital to carry 10,000 of receivables. So how did we get 10,000? So again, as I have mentioned, that the total amount of accounts receivable is just determined by the volume of credit sales and the average length of time. So we just simply multiply. So we have sales per day of 1,000 multiplied by 10 days, the length of our collection period. It means we have 10,000. So since for example, this is day 1, you extend 1,000. And in day 2, another customer will have 1,000. So going back to the first day 1, that 1,000 will be collected at the end of 10 days. So that's why you don't have cash converted yet, starting from day 1, day 2, day 3, day 4, day 5, until day 10. So that's why you need to carry 10,000 if you wanted to invest in your accounts receivable. So if either our sales or our collection period changes, of course, it will change our accounts receivable. So just for example, if our sales will double to 2,000 per day, so of course, our receivable would also double, right? So 2,000 times 20, okay? So 2,000 times 10, rather, that will become 20,000. So it will double. So the firm, on this case, would need additional 10,000 to finance the increase. So similarly, if our collection period will be lengthened to 20 days, this, of course, will double the receivable and similarly would require additional capital. So, for example, 1,000 times 20 days, and that's 20,000. So, the point here is that, going back to what I've said earlier, that if we touch the variable, the volume of the credit sales and the average length of time, it will affect our receivables. Okay, so if management is not careful, our collection period will creep up, no, as good customers take longer time to pay, and sales are made to weaker customers who tend to pay slowly, or even some customers do not really wanted to pay at all, no? So that would create bad debts. So it is very important to monitor receivables. And one easy way to use monitoring technique is the DSO. DSO stands for Day Sales Outstanding. So for example, we have here a company with credit terms of N30. So meaning the customer can pay any day within 30 days. It has average daily sales, or ADS, average daily sales of 8.2192 million, and those sales are outstanding for 45.625 days. Okay, so days sales outstanding. Okay, the length of time, our collection period. So we determine the capital tied up in receivables by multiplying them. So we will get 375 million. So that metric, that investment of 375 million is tied up in our customers' hands. So in evaluating our DSO, it is good to compare our DSO with the industry average. So if the industry average is only 36 days, then our practice of 45.625 days is actually not good, right? Because on the industry average, it only takes 36 days to collect, while we are collecting by 45.625 days, and that's too much already. Okay, so our objective would be reducing our DSO, or Day Sales Outstanding, or collection period. So we have the proposal. So if we wanted to reduce the DSO and meet the industry average 36 days, then what will happen to our capital tied in receivables? As you can see, just multiply the average daily sales of 8.2192 million multiplied by 36. So our answer would get 295.89 million. And that means a decline of 79.11 million. And that is very good because you can actually put that money in some another opportunities that would give you higher rates of return. So of course, our DSO can be compared to our own credit terms. Okay, so another use of DSO is to compare it to our own credit terms. So our DSO is only 45.625 days, yet our credit days is 30 days. That is our credit term, right? So, our DSO should not be greater than 30 days because that is the term when you extended credit to the customer that he or she should pay within 30 days. But in reality, what happened to our receivable is we are collecting only by the 46th day. So obviously, some customers are paying late. So there is room for improvement in our collection policy and practices. Okay, so the total amount of accounts receivable outstanding at any given time is determined by the volume of credit sales and the average length of time between sales and collection. Okay, so again, our accounts receivable outstanding or the capital that we spend in accounts receivable is determined by our volume of credit sales and the average length of time between sales and collections. So for an example, let's solve this problem. Suppose a firm has sales of 1,000 per day and that are all on credit, and it requires payment after 10 days. It has no bad debts or slow-paying customers. So, under these conditions, it must have the capital to carry 10,000 of receivables. Okay? So, how did we get 10,000? So, that is sales per day of 1,000 multiplied by the length of collection period of 10 days, and that's 10,000. So, ibig sabihin, you need to have a capital of 10,000 in carrying your receivables because you will extend in one day, in any day, you will extend 1,000 to a customer and that will take 10 days. So, in every day, a customer will apply for credit and that's another 1,000. So, ibig sabihin, within those 10 days, you should have 10,000 so that you can maintain giving out receivables. Okay? So, that's 10,000. So, another example. So, for example, the company credit terms is N over 30. Okay? So, N30 means any day as long as you pay within 30 days. So, we have the receivables. So, for the receivables, we have here the this is now time for self-check question number 2. So here, this is the summary of our trade-offs in credit and collection policies. So first action, relaxation of credit standards. If we relax our credit standards, so you mean credit standards, the standards, sino yung customer na bibigyan, magkano lang yung bibigyan, okay, and the likes, okay? So if we relax that, The benefit would be increased in sales and contribution margin. So our cost would be increased in accounts receivable because, of course, if pababain mo yung standards mo, like let's say, the capacity to pay, no? So, dati-rate, your standard is only those people who have net worth of, let's say, 500,000 will be able to apply for credit. But if you relax that, ibig sabihin, bababaan mo yung standard mo. So, gagawin, let's say, 100,000. Of course, many customers will qualify on those standards. So, you expect increase in sales kasi maraming uutang, but the cost is may increase din yung accounts receivable mo. Ma'am, bakit siya nasa cost? Because it is costly to maintain accounts receivable because that is already your cash. But you put that cash in the hands of your customer, and that is too much of a cost already because some customers really do not wish to pay. Okay, so second is lengthening of credit period. So if we lengthen our credit period, of course, many customers will be attracted because from 30, ginawa mong 60 days, so medyo matagal bayaran, so many customers are naturally attracted. So, of course, the benefit increase in sales and contribution margin. The cost is higher capital cost. Okay, the higher capital invested in the accounts receivable. Okay, third action, if we grant cash discount. So, the benefits is increase in sales and contribution margin and opportunity income on lower accounts receivable investment. So, the assumption is customers will pay early, so we will have lesser investment tied in accounts receivable. So, our cost would be lesser profit. So, of course, binabaan mo yung presyo, so medyo mababa na din yung profits. And last, intensified collection effort. So, the benefits is or are lower default cost. So, since medyo intense yung collection efforts mo, so there's a lower tendency of customers not paying, no? Because medyo makulit ka, mangolekta. For another is lower opportunity cost. Of course, because of your collection efforts, customers will pay, so that will reduce our opportunity cost. Only the cost is the higher collection expenses. Okay, so if you can observe, some of the finance companies, they have collectors, they have collecting agents, no? So if you employ collecting agents, then of course you need to pay them, no? So that's higher collection expenses. So this is the format in how we analyze receivable management problems. Okay, so as you can see here, there's a column for current. So this is our current policy. The second column is for the proposed policy. Okay, so first we need to consider the capital cost. Okay, so compare the capital cost, the cost of sales. No? So the cost of sales, so that's why we need to, usually the problem gives the sales in amount, gross amount, and we'll just give a variable cost ratio or a cost ratio. So you need to multiply that one to get the cost of sales. So you just plug in for current and proposed. You compare. Then we divide that with accounts receivable turnover. How many times our average accounts receivable will be collected in 1 year? So accounts receivable turnover is simply 360 or whatever the problem assumes, 365 days divided by our days sales outstanding. So if we have, for example, days sales outstanding of 30, so you divide 360 divided by 30, that is your turnover. The number of times that accounts receivable will be in your operation. So just plug it in to get our average receivables. So our average receivables here, then we add the opportunity cost. Okay, so that will be our total capital cost. For our collection cost, we just simply plug in our collection expense and our discounts extended. For delinquency and default cost, we have to consider the bad debts expense. And for discounts given, we get the discounts that we extended to customer. So we add them all. That is the total accounts receivable related costs. Okay, so our objective is to reduce the investment in receivables. So the lower investment cost will be the acceptable alternative. So again, the lower the cost, the better. Okay, so there are cases where increase in sales is the result of new accounts receivable policies. Then the corresponding increase in contribution margin will have to be factored into our computation. So, ito yung format that we can use in analyzing receivable management, especially if we are evaluating proposals to improve level of receivables through first, relaxation or tightening of credit policy to increase sales, change in credit terms, and third, extension of cash discounts to induce prompt payments. Okay, so time for self-check question number 3. Okay, so we have here a sample problem. Okay, Ahmad Company has an inventory conversion period of 60 days, a receivable conversion period of 30 days, and a payable payment period of 45 days. Ahmad's variable cost ratio is 60% and annual fixed cost of 600,000. The current cost of capital for Ahmad is 12%. If Ahmad's annual sales are 3,375,000 and all sales are on credit, question, what is the firm's carrying cost in accounts receivable using 360 days per year? So we have here a very specific period for year, and that is 360 days. So we get the turnover 360 days. So 3,375,000 divided by 360 days times 30 days. Okay? So we get average daily balance of 281,250. Why 30 days? We use 30 days because this is our accounts receivable conversion period or day sales outstanding or collection period. So we have here the capital invested 281,250. So our average investment would be 281,250 multiplied by the cost ratio to get the cost of sales. So 60%, so we get 168,750. So therefore, our carrying cost for this receivable investment, so just multiply that with 12%, so we get 20,250. Okay, so this is the carrying cost of our accounts receivable, 20,250. And so we have here our second problem. Aisha Company sells on terms 3, 10, and 30. Total sales for the year are 900,000. So 40% of the customers pay on the 10th day and take discounts. The other 60% on average 45 days after their purchases. What is the average amount of receivables using 360-day year? So we need to determine first our days sales outstanding. So it says here in the problem, we have 40% of the customers pay on the 10th day. So 0.4 times 10. Then we add the 60%, 0.6 times 45 days. So we get the DSO of 31 days. So now we can get our average accounts receivable, and that is 900,000 divided by 360 times 31 days. So we have 77,500. Okay. Okay, so we have here our third problem. What if there is a change in accounts receivable policy? Okay, so we have here a problem. Currently, Hisham Company has annual sales of 2,500,000. Its average collection period is 45 days and bad debts are 3% of sales. The credit and collection manager is considering instituting a stricter collection policy whereby bad debts would be reduced to 1.5% of total sales and the average collection period would fall to 30 days. So, meaning from 45 days, gagawing 30 days, and from 3% bad debt, we wanted only 1.5. However, sales would fall also by an estimated 300,000 annually. Variable costs are 75% of sales, and the cost of carrying receivables is 10%. Assuming a tax rate of 40% and 360 days per year, what would be the decrease in investment in receivables if the change were made? So we need here to determine what is the effect. So for this change in average accounts receivable, we have yung planned. Our plan is from 2,500,000 annual sales, it will be fall by 300,000, meaning to say our annual sales will only be 2,200,000. So 2,200,000 divided by 360 times 30. So why 30? Because from 45, gagawin natin 30 days. So 2,200,000 divided by 360 times 30 is equal to 183,333. That is for our planned. Our present is 2,500,000 sales divided by 360 times 45. So we have accounts receivable of 312,500 at present. So there's a decrease in accounts receivable balance of 129,667. So again, you just simply deduct 312,500 minus 183,333. So multiply that with the variable cost ratio because we wanted to get the cost because we are concerned about the cost. Okay, our variable cost ratio is 75%. So meaning to say 129,667 multiplied by 75%, we have a decrease in investment in accounts receivable of 96,875. So this decrease in investment in accounts receivable, though the word may be decreased, but this is actually beneficial in our part because we are actually releasing some funds that are tied up in accounts receivable. So we can invest this 96,875 in somewhere place that gives higher return. Okay, so we have here our last problem, and this is a comprehensive problem. Okay, so Mariam Company is considering changing its credit terms from 215 and 30 to 310 and 30 in order to speed up collections. At present, 40% of Mariam Company's customers take the 2% discount. Under the new term, discount customers are expected to rise to 50% to avail of the discount. Regardless of the credit terms, half of the customers who do not take the discount are expected to pay on time, whereas the remainder will pay 10 days later. The change does not involve a relaxation of credit standards, therefore bad debt losses are not expected to rise above their present 2% level. However, the more generous cash discount terms are expected to increase sales from 2 million to 2.6 million per year. Mariam Company's variable cost ratio is 75%. The interest rate on funds invested in accounts receivable is 9%, and the firm's income tax rate is 40%. So for our first question, what are the days sales outstanding, or the DSO, before and after the change of credit policy? So we have here for the old policy, so that's 40% at present, 40% take the 2% discount, so that's 0.4 times 15-day discount period plus 0.3, okay, 0.3, half of the customers who do not take the discount. So for those who took the discount, they are 40%. So the remaining who did not take the discount, 60%. So they are paying within the time. So 0.3 times 30. Then the remaining will be 10 days late. So 0.3 times 40. So you plus that. 0.4 times 15 plus 0.3 times 30 plus 0.3 times 40, we get 27 days. Okay, so let's compare to our new policy. Our new policy, the discount customers would expected to be 50%. So meaning 50% availing the discount and the remaining 50% do not avail the discount. So 50%, 0.5 times 10 days, because we will change the discount period from 15 to 10. So 0.5 times 10 plus the half of 50, 0.25 will pay on time, 0.25 times 30 days, plus the remaining half will pay 10 days later, so 0.25 times 40 days, okay? So 0.5 times 10 plus 0.25 times 30 plus 0.25 times 40, we get 22.5 days. Okay, so our DSO for old policy is 27. Our DSO for new policy will be 22.5 days, and that would be better. Okay, so second question, the same problem. What is the incremental carrying cost on receivable? The incremental, we are looking here on the increase, the change in carrying our receivable. Okay, so our average receivable. So we need to compute our average receivable. So under the new policy, our sales will be 2.6 million. So divided by 360 times the new DSO, 22.5. So we have average receivable balance of 162,500. Comparing that to the old policy, we have sales of 2 million divided by 360 times 27 DSO. So we have average receivable, old policy of 150,000. So from 150,000, pag i-implement natin yung new policy, we will have average receivable of 162,500. So therefore, there is an increase of 12,500. So that 12,500, okay, our increase, dapat sana yan, yung pera na magamit yan, yung 12,500, mapunta sa other interest-bearing na opportunities, and that is specifically stated in the problem that the interest rate supposedly on funds that are invested in accounts receivable should be earning at 9%. So that incremental accounts receivable of 12,500 times 75%. Again, why do we need to multiply 75%? Because we need to get the cost of those receivable, not the selling price, okay? So 12,500 times 75% times 9%. So we have incremental carrying cost of 843.75. So again, 843.75, or you can round that off to 844. Okay, so this is our last question. So what is the incremental after tax profit from the change in credit terms? So again, we take consideration now with the tax rate, no? So for receivable management problems, this is the most complex na problem that you can find if the question will be asking incremental profit, after-tax profit. So our incremental sales is 600,000, right? So from 2 million to 2.6 million. So there's an increase. That's why we put incremental. Increase in sales, 600,000. We will get the variable cost of that, and that's 75%. So we have 450,000. So this is incremental sales. That is our benefit. So these are the parentheses. Those figures denoted by parentheses are the cost. So we have the variable cost for 50,000. Additional bad debt. So 600,000 times 2%. So our bad debt level did not increase. So still 2%. So 600,000 times 2%, we have 12,000. Then we have the additional carrying cost that we have computed a while ago. That's 843.75, or for this case, we just round up to 844. Then we have the discounts. Okay, so we have 2,600,000 times 0.5. The customers availing the discount is 50%, times the discount of 3%. Just compare that with the old discount, 2 million times only 40% customers times 2%. So what is the increase in the discount here is 23,000. Okay, so from 16 naging 39,000. So we have an increase in discounts of 23,000. So we have here the before tax increase in income. So from the benefit less the cost, so we have 114,156. You can automatically multiply this by after tax rate of 60% to get the 68,493. So therefore, what this means is if we change our credit terms from 215 and 30, gagawin nating 310 and 30, we will have increase in our after-tax income of 68,493. So our decision would be to implement our new credit term because it is more beneficial for our company. This is our last self-check question number 4. Okay, class, so that will be all for this video lecture, and that is receivable management. So next lesson coming up would be working capital management, or lesson 4, inventory management. So stay tuned.